Hello everyone. Good day to all of us. I hope you are safe wherever you are now. So just listen to this video about our new lesson. By the way, our last lesson last week is about the formation of partnership. So last week we tackled about um, what is the definition of partnership, and we also discussed the characteristics of partnership. And also, we also have made accounting entries for the investment of the partners. So after the formation of partnership, they are now ready for operations. So partnership now will start earning the profit, earning revenues, incurring expenses. So it depends upon the form of business organization of the partnership. It may be a merchandising type of business wherein they buy and sell, or uh, service type business wherein they render services to their customers. But all of those entries are mostly the same with um, sole proprietorship. I believe all of you are already familiar with all those entries because all of you are have already taken up basic accounting. So for this topic, partnership operations, we will discuss immediately the division of profits and losses. Now again, now we will no longer tackle the usual entry of earning income, or incurring expenses, or payment of liabilities, or receipts of receivables from your customers. Those are all tackled in accounting one. But it could also happen to partnership. In fact, regardless of form of business organization, it may be sole proprietorship, partnership, or corporation. All of those entries are the same. No? The unique part of partnership is only the division of profits and losses. Because in sole proprietorship, whatever is the profit, it will go to the partner. Whatever is the loss, it will be absorbed by the owner rather. So whatever is the profit, it will go to the owner. Whatever is the expense, it will be absorbed by the owner himself. But in case of partnerships, we have to divide the profits and losses. This is critical part in the partnership because this is the primary purpose why the partnership was created, in order to gain profits. So it is really critical, because the if the way of your division of profits and losses is wrong, it may cause um, misunderstanding among the partners, and it's not good. So whatever is the manner of the division of profits and losses should be laid down clearly, by the partners. So the division of profits and losses could be done equally. So this is the simplest method, because depending on how many the partners are. No, it could be two or three. No, if there are two partners, you just divide it by two. If there are three partners, you just divide it by three. There are four partners, you just divide it by four. No, it's so simple. Second is in an equal or arbitrary ratio. Third is in the ratio of partners' capital account balances. Fourth is allowing interest on partners' capital account balances and dividing the remaining net income or loss in a specified ratio. Number five, allowing salaries to partners and dividing the remaining net income or loss in a specified ratio. And number six, bonus to managing partner based on net income. All of this will be discussed, but in this video, we will only discuss the first three manner, the division of profits and losses. The next three, the remaining three, will be discussed on the next video next week. So first, we will discuss this illustration. We will use this illustration for the rest of the video. So assume that on December 1, 2015, A and B formed a partnership with an investment of 30,000 by A and 60,000 by B. On December 31, 2016, after closing all income and expense accounts, the income summary account shows a credit balance of 60,000 pesos. Okay, so representing the profit for the year 2016. So take note of this, class. Whatever is the balance of the account income summary, or in other books, this is uh, used. This is discussed as income and expense summary, but they are just the same: income summary or income and expense summary. So whatever is the remaining balance, so after you close all income and expense accounts, represents a profit or loss. If the remaining balance is a credit balance, it is a profit. If the ending balance is a debit balance, it is a net loss. So in this example, there's a credit balance of 60,000, meaning the business made a profit. So changes in the capital accounts during 2016 are as follows. So these are the changes in the capital accounts of the partner. So first, we have here beginning balance. On January 1, 2016, for A, it's 40,000, and for B, it's 60,000. We have additional investments. So both of them made additional investments on March 1. For A, 20,000, and B, 50,000. Both of them again made additional investments on August 1. For A, 20,000, and for B, 40,000. A made a withdrawal on October 1, that's a permanent withdrawal of 20,000, and B made a withdrawal on November 1 amounting to 50,000. So there is this ending balance on December 31, 2016, 60 for A and 100,000 for B. Okay, so since this illustration will be used throughout the video, you should know the key amounts, no, that you could see here. Okay, so on the top, no, the highlighted in blue, we have here the original investments or original capital contribution of the partner. So for A, it's 30,000 and B, 60,000. Original capital contribution represents the amount being invested by the partner by the time that the partnership has been formed. No? In our last topic, we discussed the formation of the partnership. So whatever is the original capital made by the partners, that is their original capital contribution. Okay? We also have here the happenings for the year 2016. Okay, so our base year in this illustration is 2016, although the partnership were formed on December 1, 2015. So on January 1, 2006, we call this beginning balance of capital. A is 40,000 and B is 60,000. No? When we say beginning balances, it's the balance of your capital on January 1 of that particular year. No? And lastly, the ending capital balances, no? That is shown on the bottom part. So 60,000 for A and 100,000 for B. So ending capital balances is the balance of the capital of the partners at the end of the year. So original, beginning, and ending. You should know how to find those accounts. By the way, no, if you are using a T account, no, I'm sure all of you already know what a T account is. Now, if you look at the T account for that particular year, no, in T accounts, the left side, no, represents the debit, and the right side represents the credit. So whatever is the first amount that you can see on the credit side of the capital account, that is the beginning balance of the capital. Okay. So if the profit will be divided equally, no? So this agreement to divide profits and losses is common in practice because of its simplicity. So simple lang siya, no? Because the computation is very simple. So on December 31, 2016, no, the net income of 60,000 is transferred from income summary account to the partner's capital account by the following closing entry. Okay, so we have here debit to income and expense summary of 60,000 and credit A capital 30,000 and B capital 30,000. Okay, so again, so since this is the most simple computation of the division of profits and losses, we'll just divide the net profit or net loss depending on the number of partners a partnership have. No? So since there are only two partners in this case, so 60,000 divided by 2, A will receive 30,000 and B will receive 30,000 also. So if you notice, we debited the income and expense summary. The effect of this entry is that we will close the income and expense summary because since this is a profit, no, the balance of income and expense summary or income summary has a credit balance. So in order for you to close an account with a credit balance, you need to debit it. That's why in this entry, we debited income and expense summary. And we credited the capital account of the partners. That means, in this case, the capital account is increased, no, both by 30,000, both to A and B. Okay, on the other hand, if the business operations resulted to a loss, no, let's say for example, this is a net loss, the income and expense summary would show a debit balance of 10,000. So opposite, no, to the previous discussion, no, if the operations resulted to a loss, there is an ending balance in income and expense summary of debit. No, in this case, 10,000. The loss is transferred to the partner's capital accounts by the following closing entry. Okay, so in this case, we will debit the capital account of the partners for their share in the net loss, and we will credit income and expense summary amounting to 10,000. Okay, so the effect of this entry class, debiting a capital account will decrease the capital account of the partner. And we credited income and expense summary, meaning the income and expense summary here is already closed. No? Because originally it is a debit balance and we credited it, meaning after this entry, there are now zero balance for income and expense summary. So if you notice, nabali lang ang entry. No? If it's a profit, katong previous nga entry, but if it's a loss, ingon ani nga entry, we will credit income and expense summary and we will debit the capital account of the partner. Okay, division of profit and loss in an arbitrary or unequal ratio. So in this case, dili na siya equal. So if the division of profits and losses is unequal, no, that manner of the division of profits and losses should be stipulated in the partnership agreement. So in this case, no, let us assume, no, that A and B, no, agreed to divide profits and losses in the ratio of 60% to A and 40% to B. No? So probably in this scenario, since A has a larger share, maybe A has more influence in the business, no, or A has more responsibilities in the business, no, kay mas dako man siya og share, no, in the profits and losses. So it's not always good, no, to have larger share, no, because if you have a larger share of the profit, that would also mean a larger share of the loss, no. Probably in this example, A has more participation than B. So since A has more participation than B, if the business incurred a profit, that would be good for A. But if the business made a net loss, that would be bad for A. No? But since A probably has more participation in the business, that is somehow fair. No? So in this case, no, since we are still assuming, no, that the business made a net income of 60,000, then I guess it would be good for A. No, but the reasons, no, there are variety of reasons, no, various reasons why would the partnership agree to an unequal rate no, it's not always fair, no. Sometimes it's unfair, no. But as to the reason why they would agree to an equal division of profits and losses, it's up to them, no. As long as we are looking at their partnership agreement, and whatever is in the partnership agreement, we should implement that in the division of profits and losses. So 60% kay A, 40% kay B. This is somehow an easy computation. So you'll just multiply the net income of 60,000 by 60%, and it will be the share of A. And 60,000 times 40%, that would be the share of B. Okay, so our entry would be still a debit to income and expense summary, 60,000. And we will credit A capital, 36,000, and credit B capital, 24,000. No, so this computation is not so complicated, no. Although mas simpler gyud ang equally, no. Okay, so next, the partnership could also agree, no, that the division of profits and losses will be based on partners' capital account balances, no, or their contribution, no, to the partnership. So the capital contributions of the partners are usually considered in the determination of profit and loss sharing agreements. If partners' capital is considered in allocating partnership income, the agreement should specify whether the ratio is based on the original capital contributions, the beginning capital balances, the ending capital balances, or the average capital balances, no? So they should agree, no? But if the partners have this same level, no, of contribution, no, in terms of effort, no, and work in the partnership, this the capital ratio is, I think, the most fair, no, uh, the most fair way of dividing profits and losses, no? Since it is based on what they really contributed into the partnership. So again, we will go back to our illustration a while ago, no, because you should know these figures, because these are the figures that are critical, no, to our next computation. So again, let's go back. So when we say original capital contribution, it is the capital contributed by the partner by the time that the partnership is formed. So original capital contribution for A is 30,000 and B 60,000. Beginning balances of capital is the capital balances on January 1 of the year. So for A, it's 40,000 and B, 60,000. Ending capital balances is the capital balance on December 31 of each year. So for A, 60,000 and B, 100,000 pesos. Okay, so how do we divide an amount using a ratio? No? So somehow there is more complications here because we will now be using a ratio. Okay, so just a brief review, no, of your math. No? So let's have this example. You divide the amount 10,000 pesos using the ratio 2:3. No? So what do we mean by the ratio 2:3? No? So meaning the first part or the first amount will have two parts and the second amount will have three parts. So how do we begin? How do we divide the 10,000 using this ratio? Of course, we have to arrive at this fraction, no, that we will multiply to the amount. So where did we get this? So the numerator of the fraction should come from the ratio. So since the ratio is 2:3, now the first amount should have a numerator of 2 and the second amount should have a numerator of 3. And the denominator will come from the sum of the two numbers. So 2:3. So 2 plus 3 equals 5. Okay, so this means that in the dividing the amount, no, the two parts will go to the first person and the three parts will go to the second person, meaning there are all in all 5 parts. So if you are able to arrive at this fraction, you will now multiply this to the amount, which is 10,000 pesos. So 2/5 times 10,000 equals 4,000, and 3/5 times 10,000 equals 6,000. So if we will divide 10,000 pesos using the ratio 2:3, the first amount will be 4,000 and the second amount will be 6,000. Let us apply this, no, using the scenarios in partnership. So let us divide the profit of 60,000 pesos using the original capital ratio or the original capital contribution. So as we discussed a while ago, A's original capital contribution is 30, while B's original capital contribution is 60. We will use that ratio. So first number will be 30,000, no, over 90,000, and second number will be 60,000 over 90,000. So where did we get 30,000? It's the original capital of A. Where did we get 60,000? It's the original capital of B. And where did we get 90,000? It's the sum of their original capital contribution. So 30 plus 60 equals 90,000. If we are able to get that fraction, we'll multiply it to the profit, which is 60,000, which means A will receive 20,000 share and B will receive 40,000 pesos. So that's how we are going to divide an amount using a ratio. Now let's go back. No? If we will divide, no, the profit, which is 60,000, using the original capital contributions of the partner, the journal entry would be, we will debit income and expense summary of 60,000. We will credit A capital of 20,000 and B capital of 40,000. No? So since this computation was made a while ago, no, this is the summary of the computation. No? Next, that is if original capital atong gamiton. No? Note, okay, this is an important note. In instances where the manner of the division of profits or losses is not provided in the partnership agreement, meaning in their written agreement, walay nakasulat dito nga unsaon nila pag-divide sa profits or sa losses, the original capital contribution should be used. Okay, so meaning in this case, if there are no agreement among the partners, we will use 30:60, no, for the division of profit. Okay, division of profits and loss using beginning capital balances. So if the profit of 60,000 is divided using beginning capital balances, no, the journal entry would be, okay, let's go back to the data, no, a while ago. So our data for beginning balances, no, since we are using now beginning balances, how much is the beginning balance of A? It is 40,000 right here. Okay? And how much is the beginning capital of B? It's 60,000. Okay? 40,000 and 60,000. Let's go back. Okay, so this is the computation, no? So for A, no, A has a beginning balance of 40,000 and B has a beginning balance of 60,000 over 100,000, which is the sum of the beginning balances. We multiply that with the profit, which is 60,000. Okay, and the arriving amount will be, for A, it's 24,000 and B is 36,000. Okay, so that is the share of A and B respectively. So the journal entry would be debit income and expense summary 60,000 and credit A capital for his share, which is 24,000, and B capital for his share, which is 36,000. Okay, lastly, the division of profits and losses using ending capital balance. So if the profit of 60,000 is divided using ending capital balances, the journal entry would be, okay, how much is the ending capital? Let's look at the data again. Okay, so where is the ending capital of A? Ending capital of A is here, 60,000 pesos. And ending capital of B is here, it's 10,000. 100,000 rather. Okay, so A, 60,000, B is 100,000. So meaning, let's go back. Okay, so this is the computation. So 60 for A, 100,000 for B, over 160,000 pesos. No, the sum of the ending capital balances. You multiply that by 60,000, which is the net profit, you'll arrive at, for A, 22,500 and B, 37,500. That is their share for that from that profit, provided that the partnership agreement uh, says that they will divide profits based on ending capital balances. Okay, and the journal entry to record the division of profits is a debit to income and expense summary, 60,000, credit A capital, 22,500, and credit B capital, 37,500. Okay, so um, I think this is all. No? Okay, thank you very much, no, for listening. No? Take care and stay safe. No? God bless us all. No? So please don't forget, no, to answer the exercises provided in the modules, no, and attach all those answers in the Google Classroom. No? Always follow instructions. So be careful in reading instructions. Okay, thank you very much, and good day to all of us once again.